Right now, the U.S. is blockading the Strait of Hormuz.
Yeah, and limited military strikes are reportedly on the table to break this stalemate in peace talks.
Right, missiles are literally flying. But, on Wall Street, analysts aren't panicking at all. They're actually calculating exactly how many millions of dollars this chaos is worth.
Exactly. And today we are looking at an April 13, 2026 UBS research note.
Yeah, a document that clinically maps out how this massive geopolitical escalation flows directly into the balance sheets of three distinct energy sectors.
Right, so we are talking integrated oil, refiners, and midstream companies.
Okay, let's unpack this. We want to take the next 10 minutes to clearly explain the specific logic of this document and how Wall Street maps a breaking crisis to corporate profits.
So the immediate assumption with any blockade is supply squeeze,
Yeah,
right, which obviously drives up crude prices.
sure.
And UDS lays out the sheer scale of this leverage for the integrated majors. I mean, a single $1 per barrel increase translates to roughly $600 million in incremental earnings for Chevron. Yeah, and like $700 million for ExxonMobil.
Wait, so it's like owning a casino where the house edge just went up, but someone is actively throwing rocks at your building, right?
What's fascinating here is that is exactly the paradox. The conflict generating this windfall on paper is the exact same conflict putting their physical infrastructure right in the crosshairs.
Like Exxon's stake in Qatar Energy's Rohorslafan complex. I mean, the extensive missile damage there could keep key LNG trains offline for, what, 3 to 5 years?
Yeah, 3 to 5 years. And Chevron's Leviathan gas field in Israel already saw a 33-day shutdown earlier in the crisis.
Right.
So it creates this stark reality check. The crude price spike inflates their earnings models, but the geographic vulnerability of those global assets severely discounts that value.
Because Wall Street literally has to price in the risk of losing the asset entirely.
Exactly.
So if big oil's international assets are just sitting ducks right now, capital naturally hunts for a geographical premium, which means moving away from the Strait of Hormuz.
And straight to North America.
Here's where it gets really interesting, because U.S. refiners are substituting that risky global supply with Canadian heavy crude from the Western Canadian Sedimentary Basin.
Right, because U.S. refiners are largely insulated from OPEC dependency. They actually have the flexibility to make that pivot.
Yeah.
When you remove supply certainty globally, but a domestic refiner has a secure pipeline to Canada, their crack spreads just widen dramatically.
Let me push back on that, though. I mean, if Valero is suddenly seeing a massive margin expansion and UBS notes an $837 million pre-tax earnings boost for a $1 increase in global refining cracks,
Right.
aren't their logistical and supply chain costs just skyrocketing to reroute and secure all that heavy crude?
Well, no, because the geographic advantage actually negates that cost. The infrastructure connecting the Western Canadian Sedimentary Basin to U.S. refiners is already built.
Oh, right.
It is politically stable, and it's completely overland.
Yeah.
So Valero isn't paying wartime maritime insurance premiums.
Or dealing with blockaded shipping lanes, yeah.
Exactly. They are buying discounted, heavy crude, processing it really efficiently, and selling refined products into a global market that is totally starved of supply.
So that wider crack spread just drops straight to the bottom line,
Completely.
which really makes the midstream operators the ultimate beneficiaries here.
Totally.
It's like a critical toll road operator in a region where all the alternative routes just became active war zones.
Yeah, the global traffic has to flow through their specific pipes. It allows them to basically print money without taking on the actual geopolitical risk.
And OneOak is the perfect case study in the document for this, right?
Yeah, absolutely. I mean, they built their entire 2026 financial guidance, assuming crude would hover around $55 to $60 a barrel.
And now with the blockade pushing crude to $75 or $80?
Right, the volume demand on safe domestic pipes pushes their throughput to maximum capacity. They capture the premium pricing of a global crisis with zero exposure to the actual conflict zone.
So what does this all mean for you as you watch this play out?
Well, it reveals the highly clinical nature of global finance. Markets don't just freeze during a crisis.
Right. They simply redirect the flow of capital away from those vulnerable high-yield zones towards structurally secure domestic infrastructure.
It is a calculated flight to safety. When the dust settles, the financial plumbing will have aggressively rewired itself entirely around North American pipeline and refining capacities.
Which leaves you with a really critical question to consider. If safe domestic energy infrastructure is suddenly yielding these massive premium returns, purely because of global instability.
Yeah.
Will this permanently shift the center of gravity for energy investments away from the Middle East even after the blockade ends? Because once capital finds a safer toll road, it rarely goes back to the one dodging rocks.
That is the big question.
Definitely. Thank you so much for joining us for this deep dive. Make sure to subscribe to this channel because the analysis in our next deep dive is going to be even more exciting.